Good afternoon, everyone. Today we are reviewing an economic and market update just to kind of timestamp this conversation. It is, oh, I blanked on the date. It's August 11th, 2023. So this is going to be recorded. We're at one of our live sessions. This will be slightly longer. Just I'll be able to give a little bit more explanation on a lot of the talking points. So just strap in for that and feel free to skip ahead to some charts that you had specific interest in. But really, what I wanted to do today and what I wanted to kind of make this presentation about is giving a good stance of where we sit economically, what's happened over the last few years that has led us to kind of where we are today, mid to late 2023 at this point. I'll focus primarily on the front end of this presentation on kind of economic drivers we've seen, and then move into market and investing principles on the back end of this presentation here. But it's really going to be something you can look at it as a whole, or if you do want to just kind of take some nuggets here, I'm not necessarily going to be giving any sort of recommendations or be giving my viewpoint on where we're going from here. I really want this to be just genuinely an update video of what we see happening right now. But to kind of start things off, I want to start off with the conversation of really breaking apart what is the stock market when we talk about the stock market and its difference between what is the economy. So, this chart I think does a really good job of showing that you have the stock market in blue here and you have the economy in gold, that they are not the same thing. They're correlated, but they are different and they can move at different times for different reasons. So, what you typically see with a normal economic cycle here is you have kind of a growth period to a peak, then you have a drawback period to a recession going into a growth period. You can see the stock market does a similar thing, but it usually does it slightly ahead of the economic cycle. Like it will peak prior to and it will bottom prior to. So, like an example of this gray bar being a recession, the stock market bottoms and starts to recover typically when you still see economic data worsening or getting a little bit worse in the news at that point. So they are correlated long term, but short term, they can be two very, very different things. So I want to make sure when we're talking today about that and you're thinking about this, I find it's easier, at least common, to hear people kind of interchange market and economy, stock market economy, but they are two different things when you're talking about them. Now, I want to start with the economy, and I want to start off, and let me move my face here to not block everything. So, I want to start off looking at this chart. So, this is a chart provided by Fidelity of where they kind of ballpark the US being in its current business cycle. So, that's going to be this light blue circle right here with Australia, Canada, and Korea. And they are kind of essentially stating that you're probably looking at having the US somewhere late business cycle. Usually that means credit's tightening. Usually that means earnings are starting to come under pressure. Inventory and sales growth is starting to, inventories are growing, sales are starting to fall back a little bit. Now, I always like to explain with this chart, just because this circle's right here and not up here where India and Mexico are, or not up here, that doesn't mean that a recession is pending and like it will happen soon. It could be a year, it could be 2 years. It just means that's where they're estimating we're at, because we're seeing a lot of signs that you typically see in a later business cycle. So let's look at a couple of those. So one of them being tightening credit here, and I'm going to move myself. Again, I'm actually going to shrink myself just a little bit to make it easier. Tightening credit here. So what you can kind of see here is you are starting to see tightening increase with small, mid-size, and larger banks. Ultimately, what that does and what that means is if you were a small business or a large business and you were trying to expand and you can't do that off revenue alone, your small business is going to require some sort of lending, so some sort of debt. It is getting more and more restrictive for you to be able to take out that debt. Banks are getting stricter on who they'll lend to, they're getting stricter on parameters. You're seeing interest rates rise pretty dramatically. So there's a likelihood you might not be able to afford that. And what that ultimately does is that really kind of tightens a lot of the I'd say kind of belts on a lot of small businesses to where they're not able to expand. They might not be able to hire that extra employee. They might not be able to really push into trying to grow their business. And a lot of it becomes more of maintaining. And what that can do is just really start to suck some of that kind of blood flow out of the market at that point, or and out of the economy, I'd say at that point, and really start to slow things down. But it's typically something you do see later cycle. As far as earnings growth, so this chart shows the 11 sectors of the S&P 500 plus the S&P 500 as a whole right here. And what you can kind of see Q2 2023 earnings, you do see a little bit of a pullback here at this point. So there are some sectors that are doing pretty well, and there's some sectors that aren't. You see kind of as a broad market across the board, so broad companies across the board, you do see some pullbacks there on earnings growth. So again, a little bit more indicative of a later business cycle at that point. And then lastly, coming over here, I'm not necessarily as worried about the top two charts here. I really want to focus on these bottom two charts. So this light vehicle sales and business inventories to sales ratios. So light vehicle sales, it's can be kind of helpful to look at in comparison with some other charts of, do we see low sales or high sales, and that kind of goes into consumer confidence a little bit as well. And again, also small business growth of being able to expand, buy more vehicles, operating expenses around those sides of things. You see that being pretty neutral, so not really a clear positive or negative sign one way or the other. Business inventory. So business inventories have picked back up to where you're seeing larger inventories. Again, not necessarily to a level that is outrageous at this point, and it was very much a correction from what you had as a result of COVID-19 when you're looking at supply chain disruptions and supply and demand kind of mismatches at that point. So neither of these are necessarily ultimately very negative charts at this point. They're still well within kind of just long-term average ranges. You're just seeing slight upticks, and part of that too is a correction or a little bit of a normalization from the massive shock that COVID-19 was to the global economy at that point. Now, I do want to talk about the labor market at this point, because I think that is a very interesting conversation that has been a large part of what we've seen over the last few years, and a large part of the conversation around inflation as well. So there's three charts here. This larger one is job openings by the thousand. So one thing I always like to say with a chart like this, there's been a lot of commentary over the last few years on whether or not this chart can really be considered all that accurate at this point, just because what we've seen as a result from COVID-19 is you've had virtual positions become far more prevalent. Employers have had a really tough time finding candidates to fill positions. They are no longer restricted by region as to where they can hire to as well. So there's a decent argument, I think, that there is a lot of inaccuracies in the number of job openings as opposed to the number of job openings that are actively being sought to be filled by employers. And that's essentially that employers have had such a struggle to find employees over the last few years, and now can seek out open positions that are remote, that a lot of employers are leaving job positions open, or not positions, but leaving opportunities open that could possibly be filled. But they're not actually closing anything at that point. So I say that to say, like, you might have a company that has 3 or 4 jobs listed as being open, and they're taking applications, but they're not necessarily actively trying to hire, but those job openings will still show up in a report like this. Now, two that I think are a little bit more interesting to see is this voluntary quits and this layoffs at this point. So voluntary quits, that's going to be primarily individuals that are leaving their jobs in hopes and expectations of being able to find a second job or another job, and leaving at that point, or leaving and deciding they want to retire. But it's someone that's voluntarily leaving. With unemployment being as low as it is that has been something that you've seen. A lot of people are comfortable leaving their current job, knowing that there's a very high likelihood that you're probably going to be able to find a job. If you look at 2008, the last really big economically driven recession we've had at that point, you see that number really plummet quite dramatically because the optimism isn't there that you can find a job that's better suited for you or better paying at that point. So we've seen that really be a large spike coming out of the pandemic, and that's started to normalize as well. People are starting to stay at jobs and not voluntarily leave at the numbers they were prior to the last few years. Now, with layoffs, you're starting to see layoffs pick up. You've seen them drop back down a little bit. We had a wave of layoffs in 2022. It was kind of isolated to the tech sector at that point in time. We haven't seen layoffs really hit broad base across a lot of the economy at this point, but it is something that we're seeing have a uptick from where it was again last year. Again, part of this can be the same conversation that you have with this larger chart of job openings is it was so difficult for employers to find people to fill positions. The speed at which they're going to be comfortable laying off jobs is going to be possibly a little bit slower than what you might have seen prior to the pandemic, just because the labor market is as tight as it is right now. And the fear of not being able to rehire after things kind of come to would be fairly high. Now, as far as labor, though, one thing to look at is labor force participation. So, this is kind of interesting because what you see in this light blue line is prime working years, so 25 to 54, and then dark blue, it's 55 plus. So, one thing we've seen from the pandemic on is that if you are a 55 plus individual, that percent of that group, the percentage of those individuals staying in the workforce after the pandemic has dropped off dramatically. Whereas we've actually seen the percentage of individuals in that prime working years has picked up and actually picked up now to be more than it was prior to the pandemic at that point. So you hear kind of the anecdotes of, oh, well, no, people don't want to work anymore, or young people don't want to work anymore. And it's interesting because you see a shift of the baby boomer generation that is so large, is a large demographic, and they are leaving the workforce. They're either finding out that they can retire at this point in time, they've had home appreciation, and this would be kind of some speculation on my part. Home appreciations, they've been able to cash out some of the value of their equity in their home or move and take that equity, but been able to no longer have to work. It could be a various number of different reasons, but decisions of deciding to leave the workforce. I think can clearly be seen here, whereas you have seen those younger generations come back into the workforce with a lot of strength after that really big drop down spike right here of COVID-19 and the pandemic. Now, with that being said, looking at unemployment. So prior to the pandemic, we had unemployment sub 4%. So unemployment is in gray right here. Wage growth is in blue right here. And we'll talk about wage growth after in a little bit because we're going to be talking about inflation, and I wanted to kind of show that. But when we talk about unemployment, it was extremely low, historically low prior to the pandemic. We had this massive shoot up here, which, I mean, the pandemic pretty much broke most every chart we're ever going to be able to look at again. I always like to look at this one specifically where you see the pandemic go off the chart here and you see a 35 or a 13,000 number, which is crazy. But you see, we were record low, sub 4% unemployment, and we came back to sub 4% unemployment extremely quickly. So this is what I was talking about when we say we have a really like tight labor market at that point. Is if you want a job, I mean, it's pretty high likelihood that you are able to get one at this point. I mean, it is a consistently strong unemployment number at 3.7. Now, what that means though is when we talk about unemployment and we talk about interest rates, we're also talking about inflation over these last few years. So inflation has spiked. So one of the interesting things in the relationship between wage growth and unemployment I want to talk about leading into the conversation of employment is you kind of see that this relationship between wage growth and unemployment, they work opposite of each other. So when you have really high unemployment, What that typically means is the employer now has the power. So the employer has the power in the relationship, and you have a larger percentage of people that are actively looking for jobs. So you typically see wage growth tend to drop because an employer is not having to be as competitive to have positions filled, because those positions can be filled by a large number of applicants. Now, when you do get unemployment that's typically really low, what you typically see is wage growth starts to tick up. The power moves in favor of the employee at that point in time, where there's a larger percentage of people that are employed, which means that naturally there's a smaller percentage of people actively seeking employment. And then you have that wage growth start to pick up because employers have to become more competitive in a marketplace that has fewer applicants at that point in time. So when you see that, though, that wage growth buildup can be a key driver of inflation, because that kind of bleeds into, well, now the company's expenses are more, so they have to pass those expenses to consumers. Consumers are getting higher wages, which means they're probably spending more, and that really pumps a lot of money into the economy and can pick up inflation. So when we talk about inflation, we talk about interest rates, you tend to see they work in tandem. So when you have periods of really low unemployment, that can lend itself to having periods of a little bit higher inflation. So if we look at specifically the last few times we've had this kind of trend here, so we've got late 80s. Well, late 80s, you saw inflation kind of pick up. We had a recession right here. Unemployment picked up at this point. Wage growth dropped down. Inflation dropped back down. You saw the same thing in the late 90s, same thing in '08, and it kind of clusters around recessions as well. And that's what we're looking at right here with this wage growth pump, and then we've seen inflation pump up. Now, there's a lot of things that go into inflation. It is not only wage growth. I do want to make that point clear, but that is something that can be a very large driving factor. And that is something I believe the Federal Reserve is monitoring with their interest rate hikes, is wanting to get inflation back down, but knowing if we have higher and longer wage growth, you tend to see inflation be a little bit stickier. Perfect example is the 70s right here, where we had higher wage growth for an extended period of time. And then we also, in turn, had higher inflation for about a decade that was fairly sticky prior to the Federal Reserve in the early 80s really being able to tamp down and get inflation under control. Now, with the spike and drop in inflation, what we've seen over the last year, I mean, a lot of that could be explained by some wage growth. You also have supply and demand mismatches. You have supply chain disruption. So there's a lot of factors that went into it. So with the rapid increase and rapid decrease, it's not just interest rates did it. It's not just wage growth. They are a part of it, yes, but it is not as easy as this did this and you pull this lever. It's a matter of a lot of things kind of reshaping and renormalizing after essentially a global economic shutdown that we saw in 2020. But when we talk about inflation, because talking about wage growth, talking about unemployment, talking about inflation, it's one thing, but I often like hear, well, what is inflation? How do you measure inflation? So when you hear like the headline inflation, so this last Thursday, I think it was 3.2 year over year was the headline inflation. So when you hear that, really the way headline inflation is broken out, it's in 6 different categories. So in green, you have energy, red, you have new and used vehicles, purple, you essentially have grocery store food. Um, Gray, think of that retail purchases, appliances, that kind of spending. Light blue, you have travel, restaurants, leisure, and then dark blue is home, so shelter. It's essentially like the value or what you think you could rent your home for, more or less. But that's the component. So I often like to kind of point out, realistically, you can see inflation peaked at 9.1% year over year, but unless you were buying a house and a car at the same time, your regular, like the inflation an everyday individual felt, isn't going to be that blanket number. It's not going to be, oh, everything in my life is suddenly 9.1% more expensive. Because if you already own a home, you already own a car, you're not buying what, that doesn't really affect you that much. If you have like pretty set travel, you might see some of this, but it might be all of it. You might not spend as much at a certain period of time, so you might not feel as much of this. Like it'll affect you. Groceries are going to be a large part. You're going to see some in energy from what you pay at the pump, what you pay for energy bills. But it's not going to be as simple as, oh, my life is now this much more expensive. So I always like to just go over that. Now, when we talk about the Federal Reserve, I want to spend some time on this interest rate chart. One, to explain what the Fed funds rate is, but also two, to kind of explain what the Federal Reserve's job or job mandate is. So they really have two goals. They want to keep unemployment low and they want to keep inflation low. So they want stable prices and they want low unemployment. Now, what we just looked at is if you have really low unemployment, that typically means you have higher wage growth. And if you have higher wage growth, that tends to go a little bit hand in hand with higher inflation. So, one of the tools the Federal Reserve has in its toolkit is raising and lowering interest rates. So, this chart shows the federal funds rate really since the late 90s all the way to today, and then their expectations for the next few years. Now, the federal funds rate is essentially what most other rates are built off of. So, like, if you hear interest rates, a lot of people will say, "Oh, well, how are interest rates?" And they just use interest rates as like a blanket placeholder. And you're like, "All right, well, is that mortgage rates? Are you talking about corporate bond yield rates? Are you talking about 10-year treasury rates?" But in most cases, I think usually they're talking about the Fed funds rate. Like you can guess it's this one, and I think you're pretty confident guess. It's usually this one or mortgage rates, the two that people kind of at least casually throw around in conversation. You don't meet a lot of people at like a soccer game on the weekends, and you're talking, and you're like, "Oh, how are interest rates?" And I'm like, "Oh, well, the 10-year Treasury yield looks pretty good." No one says that at all. Even if they do work in finance, that's not a casual conversation topic. And if it is, you should probably not hang out with that person. But what they do with the interest, they do with federal funds interest rates is essentially raise and lower them to either kind of strengthen or weaken the economy, if you will. So I've always heard it. Probably the best way I've heard it described is the analogy of a punch bowl in a party. So you're at a party, you see the party really, really getting rowdy. You start to pull the punch bowl away. People are getting a little too tipsy, a little too drunk. You pull the punch bowl away, let things calm down a little bit. Things get a little bit boring. People are like, I might leave this party. This kind of sucks. You put the punch bowl back out, it re-stimulates everything. And then you just go through that cycle over and over and over again. So think about it here. You are slowly taking the punch bowl away in the late 90s because the late 90s was a party. Then you see the dot-com bubble burst. We go through 9/11. We have Enron. And you're like, oh, goodness, we start putting the punch bowl back into the party. Things kind of hit an equilibrium, which is pretty nice. So we stabilize. Things get a little bit too hairy again. So you're starting to take the punch bowl away as you're raising interest rates. Then we have the financial crisis. You shove the punch bowl back in. You say, hey, have as much punch as you want. And then you essentially leave the punch bowl in for about the next decade until you start to take it away. Then, right when you're starting to take it away, you have a global pandemic. And then you just say, hey, it's been a tough year. Here's a lot of punch at that point. So, I say that to say what you typically see is the economy is starting to get maybe a little bit overheated. You're starting to get signs of late cycle, and you want to kind of pull things back because if you let it run too long, you have the potential for higher inflation. So it really is a delicate balance of trying to say, all right, I want to keep inflation down here. I don't want it to spike, but at the same time, I want to make sure we don't have a lot of unemployment. So you're trying to balance keeping low employment or low unemployment and keeping inflation low. And one of the key tools is these interest rates. So, what we've seen coming out of really 2020, 2021 was 2022, the Federal Reserve saw that huge spike in inflation and was like, oh, goodness, we need to take that punch bowl away and they took it away quick. So what we've seen in 2022 is one of the fastest interest rate cycles we have ever seen at this point. It's not the most severe, so not the highest interest rate we got into. So we didn't get in the rates that were in the upper teens, almost 20%, like we saw in the late 70s, early 80s, but it was one of the quickest that we have ever seen at this point. So that was a pretty big shock to the market at that point. And we'll talk about like how that affected the stock market in the second half of this presentation. But in looking at that, that's one of the ways the Federal Reserve says, all right, we want to try and make sure inflation doesn't get out of control. So we want to do this. And one of the interesting things is as you raise interest rates and then those rates trickle through the economy, you start to see lending standards get a little bit more restrictive. It becomes more expensive for people to take out debt. Mortgages then in turn become more expensive. Companies that operate on debt, which a lot of companies operate on some sort of debt, that becomes more expensive. Companies possibly have to retool a little bit. You might see layoffs pick up, and that's one of the things that it'll be. I hate to say interesting because it's jobs, but it'll be one of the things that I think everyone will be watching over the next year is with interest rates being as high as they are right now. Usually, when you get to that level, you start to see unemployment pick back up. And that's where I think the delicate balance that the Federal Reserve is in right now is wanting to make sure inflation doesn't run rampant, but also trying to make sure unemployment stays really, really low. So seeing what they do the rest of this year and into next year will be really really interesting to watch at that point. Now, this is a little bit more of a funner chart, if you can say that about any chart, but it's consumer sentiment. So, consumer sentiment on how they feel about the stock market. Before we get into the stock market, I want to have this kind of chart on consumer sentiment. So, but mainly I wanted to note is a point to how much people hate inflation. So, if we see here, this is June 2022, sentiment was at its absolute lowest for essentially the last 50 years at this point, lower than 2008, lower than 1980. And if you looked at anything other than inflation, I mean, you had record low unemployment at that point in time. The market was not doing great, but it wasn't just absolutely getting obliterated. But inflation was really, really high. We've seen that come up a little bit as inflation has tapped down. But I always think this is just an interesting thing to see, kind of how consumer sentiment changes around different things at that point in time. Not really useful one way or the other, but I do think it's interesting. Now, jumping over to the stock market. So, first off, I want to talk about what the stock market actually is. So, the stock market is made up of individual companies. So, when you buy into the stock market, you are purchasing companies. You're either purchasing their stock or you're purchasing their debt. So, that would be bonds in the bond market at that point. So I like to show this chart because one, it is outrageous and it is overwhelming, but two, it gives you a good representation of what you're actually purchasing and the magnitude of it. So what this chart shows, each of these squares correlates to a business and the size of it matches their size compared to other businesses. So you see like Apple, Microsoft are massive, but then you see these little black holes of tiny, tiny little dots in there of the thousands and thousands of companies that make up the US market. And you can kind of see you have your massive ones like Apple and Microsoft, but you also have tiny little ones that you can't even see the symbols here. So you might have something in this little category that could be like a small software company, or you could have one of these little tiny dots be like Domino's or a company that's not even that small comparatively, but it's also not a Goliath at that point. But I say that to say, when you talk about this, there are always going to be companies that come and go. So when people talk about investing, most of the language I hear from just everyday individuals is my 401k went up or my 401k went down, or I moved from Charles Schwab to Fidelity because Charles Schwab wasn't working for me and my money wasn't growing at Schwab, but Fidelity, it was growing. Well, it's not your 401k and it's not Fidelity and it's not Schwab. that's making your account move up and down. It's what you're actually invested in. So you could have a share of Apple in your 401k, you could have a share of Apple in Fidelity, and you could have a share of Apple in Charles Schwab, and they're all going to do the exact same thing because they're all invested in Apple. So they're going to rise and fall with whatever Apple does at that point in time. So you really have to think about investing in these companies, and these companies are going to be a wide range. You have large companies, mid-sized companies, small companies, you have international companies, value oriented companies, growth oriented companies, and all of these kind of hit at different times. There's times where some do well, there's times where some don't do well. I mean, you look at this picture, you get a lot of red and a lot of green in there. So there's going to be periods where some companies do really well and then other companies don't, and then vice versa. So if you have a diversified portfolio, you're not going to maybe hit home runs every year, but you're also not going to see a massive swing every single year. Whereas you just have a couple names, you might have a 70% down year followed by a 70% up year, which is fine if you can stomach it and if it's something you're trying to do. But when it comes to retirement planning, you typically want kind of a more diversified approach. Now, I say that because a lot of people see a year like 2022 and there's a panic of, oh, well, this account can go to zero. Well, if it goes to zero, that means that every single one of these companies has suddenly failed. They're no longer in existence. And now we're in a post apocalyptic wasteland. And I don't think you're worried about your 401k at that point in time. So, I like to show this to give a really real sense to what you're actually investing in. And one of the interesting things is a lot too is looking at those top companies in the S&P 500. So the S&P 500 is the 500 largest companies in the US at that point. So I like this chart because it kind of shows top companies from 1980 all the way to 2020. And one thing you kind of note is Apple wasn't in the top 10 until 2010. And then they jumped up. Exxon, no longer in the top 10. IBM drops in and out of the top 10. And I say that to say you have companies that seem like absolute Goliaths and are completely impenetrable. I mean, you look at IBM in the 80s and the 90s. I mean, they were it. AT&T earlier than that, like 70s, 60s, 50s, they were it at that point in time, completely replaced. So I say that to say when you do individual stock investing, it's not as easy to say, all right, well, I'm just going to invest in the biggest company because the biggest company is not going to go anywhere, because not only are you probably not going to get as much growth out of that, because typically you see companies grow a tremendously quick amount to get to the top and then kind of level out. We've seen a little bit of differentiation with the big tech companies over the last 10 years, but they aren't going to be the biggest companies ever. And they're not going to be the biggest companies of all time. They could have regime changes. CEOs could come and go. Innovation could change. They could fall behind. New companies could come in, innovate better, faster, quicker, more efficiently than them, and take their place. You see this happen. So so if you hold a broad, diversified basket, you can weather the storm if a business were to fail, because you are also going to be invested in whatever comes and replaces it. But looking more out of what the stock market is and into kind of how our market has worked over the last few years. So you see, coming out of 2019, we had COVID right here, a lot of growth coming out of COVID really, really quickly. Coming into 2021, the stock market peaked really the first trading day of 2022. This is when we started to see those higher interest rates and inflation come up. So with those higher interest rates, the stock market started to price that in, and it fell very, very quickly. And we've seen a recovery, and we're about 6% off the high as of a few days ago at this point. Now, this is what you can kind of see over a long period of time. So this is late 90s all the way to essentially July of 23. And I like to point this out because what we've seen over the last 3 years is a really quick recovery, a really quick drawdown, and a pretty decent recovery across the board. This was about a year, so it's fairly long, but you can have periods of time that are 10, 3, 4, or 3, 4, 5, 10 years where the market is relatively flat. And I say that to say is it's not a linear thing. So decades like the 2010s, really nice because you can invest and you almost instantly see a return. But investing in the stock market is not the same thing as putting money into a savings account and getting interest. Investing in the stock market, you're going to go through economic cycles. You're going to have periods where you see a lot of gains. You're going to have periods where you don't see gains or you actually see losses in your account. It's staying invested for the long term, because when you look at that, stocks are very risky on the short term, but long term, they are going to be the best bet to grow for you. So I think this does a really good job of showing what a very painful decade could be. But if you stayed consistent with your investments and you didn't move to cash and you continued to invest, you do see that recovery and it makes it worth it at that point in time. Now, what I want to look at here is this chart more or less shows how expensive or cheap the market is at any given time. So, and I'm going to it's a very, very, very oversimplification, but that's where I want to kind of talk about this right now. So think late 90s, market got really, really expensive. Think 2008, market got really, really cheap. What we saw with COVID-19 was the market got very expensive, then got pretty cheap, and now is getting expensive again. So what does that kind of mean, and what can we use this information for? So if we look at this green dot right here is going to be the same as this red dot right here. So that green is the level of expense, which is going to match this red dot right here. So what this chart what this chart is showing is really expected future returns for the next 5 years with the level of expense that the market is at. So if the market was really, really cheap and it was up here, so this is like a 2008 level, you can expect the next 5 years to have an average annual return of give or take high teens, which is really, really positive. It's in the middle of a really painful time, but the outlook is positive because you're looking at a recovery. If we see a market that's really expensive, I mean, you're probably looking at having maybe a few rocky years, maybe a recovery here and there, but an average annual return of maybe single digits at that point in time. And on a rolling 5-year basis, you can see this is a pretty tight data set. So you can at least get a little bit of an inkling there. Now on the rolling 1 year, same thing, same red dot on a rolling 1 year. You see this data set's all over the place. So it's not a really useful chart at that point in time. But the 5-year, I do think, provides at least a little bit of a look of how we can set our expectations going forward. Now, to that point, though, it's not a clear road. So this is S&P 500 returns. In gray, you have year-end returns, and in red, you have intra-year declines. So we look at a 2020 right here. Intra-year, the S&P at its lowest was down 34%. It ended 16% up. Last year at its lowest, it was down 25, ended 19% up. So far this year, it's up 20% so far this year, but at its lowest, it's been down 8. And what you kind of see is you average a lot of drawdowns, even on positive years here, and you very rarely have a average year. I say it like, so if you say, all right, well, the market averages over this time period 10%. Well, you have a 10, an 11, a 9. So 3 that would be considered maybe average. Everything else is all over the place where you get some massive numbers and some massive numbers on the downside. Now, I will say, just as kind of a side note, this is where you hear the argument for like annuities pretty commonly of like, oh, well, we'll hedge you to where you don't have any downside, but we'll cap you at like a 10% increase or like a 10% return, which that looks really good if you were to start the chart here and go to here, because you have this really like negative 4 years really back to back to back to back. But if you look at it in this range or this range or this range right here, or even this range right here, that loses to just using a very simple stock market investment almost 10 out of 10 times at that point, just because you might miss this, but then you also miss 13% return here, 3% return there, 3% return here, 20% return here. So what you're able to actually get isn't going to be enough. And like right here, you still have a 0% return. You'd have a 0% return, but then you're getting all this 10, you're missing 9 of this, you're missing this downturn, but you're also missing what? 19% here, 6% here, 17% here. So what ends up happening is you need that kind of big growth years to make up for the down years. But if you just average it out, you end up losing over a long period because the market is up more often than the market is down. That point. Now, when we talk about the market, this is the S&P 500, but there's more to the stock market than just the S&P 500. So the next few charts I want to go over are going to be looking at the difference between small cap, large cap, and international. So we'll start off with small cap companies and large cap companies. So think of that as small companies and large companies. So what we have here is a chart that's over the last 3 years, and you have small companies in gold and you have large companies in blue. So what you can see is coming out of vaccine news at the end of 2021, small companies outperformed large companies, and then large companies kind of caught back up in 2022, and they have outperformed small companies over the last year. Now, what if we looked at that over the last 10 years? Over the last 10 years, large companies have kicked the butt of small companies from a return standpoint. So even though we saw this outperformance right here, so if we like this little section right here is where they really outperformed. So if we come back over here, we saw that outperformance there. But large companies have really done well. Now, let's take it a step further and say last 23 years, and you can see, well, last 23 years, small caps have dramatically outperformed large caps. So when we talk about investing, a lot of times this gets back to my point that a lot of people lump everything in together and they say, all right, well, my account is this. When they put money into their 401k, they view it as my 401k did this, not a portion of my 401k or this mutual fund or this ETF or this basket of stocks. And what you look at is when you're talking about investing, even if you use like a target date fund or a portfolio fund that does all of this in, you're going to have different things that perform differently at different times or differently over different time horizons or time periods. Like small size companies typically outperform large companies given a long enough time period. But to get that outperformance, you might have to go through a decade of underperformance before you get a real period where they outperform and you see that really pay some benefits at that point. So I say that again, as investing is a long-term thing, but you also have to make sure you're building your portfolio accordingly, and you have to make sure your portfolio matches your goals and what you're ultimately looking for. Like if you are a younger investor, you know you're not going to touch these assets, you can afford to be heavier or a higher allocation to small size companies because you have time. And if you are if you're looking for long-term growth and you know, hey, I'm in my 40s or my early 50s, but I know this account's really got to last me into my 80s and 90s. I mean, you still have a really long time horizon at that point in time. So it's keeping that in mind that just because something might be really overperforming for a year or 3 years or even 10 years, it doesn't necessarily mean that it's going to be the outperformer over a really long period of time. Now, so that's US small, US large. Now, if we look at international, broad international versus broad US, you kind of see a similar thing. So in purple is periods where international outperforms, and gray is periods where the US outperforms. So you've kind of see it trade off every so often. So like right here, you saw really dramatic outperformance internationally compared to the US. Then that went back to the US, back to international, back to the US, back to international pre 2008. And then since 2008, you've really seen US be the outperformer. And then recently, the internationals outperformed really like 2022 and a little bit of this year. So it goes back and forth. But again, like if you hold any international during this decade, you're like, why am I doing this? This is the worst return I've ever gotten. I could have just been holding the US market and done great. But that's the exact opposite here. So you have to really look at what you're trying to do and how you want to diversify your portfolio. Now, looking at this is US versus international over the last 10 years. So, to my point, kind of like you've seen right here, internationals in blue, they've lost to US large cap and US small cap. Over the last 1 year, this is where international in blue really started to outperform. It wasn't until very recently that the US large cap has started to catch up. But I mean, you look year to date, and that's so you see 2022 international really outperforms. You hit year to date, which is going to be right here. And even though it looks like you get some outperformance there, if you start that year to date, international is the worst performer between small US and large US. So I say to say again, I'm using this to really reinforce different parts of a diversified portfolio might seem like they're not working today, but they might have worked a year ago, or they might be working for your long term picture. So, not every part of your portfolio has to be hitting home runs all at one time for it to work. You build that portfolio so that you can have a consistent target for what you're shooting for, and then know that different parts of that portfolio are going to work at different times. Now, moving to bonds, away from stocks, I'm not going to spend as much time on bonds. They're not as sexy of a topic. I'm sure there's some bond fund managers that would very, very dramatically argue that point. But I really just want to point out that last year was the worst year on record for US bonds. Part of that being this really dramatic interest rate rise, but we saw the worst recorded year for bond returns. Now, I always like to describe what happened last year this way. If you can buy a bond for $100 and it's going to pay you, and I'll move it to work, and it's going to pay you 2%. And then next week you can buy a bond for $100 and it's going to pay you 3%. You are going to buy the 3% bond, but the 2% bond is going to have to go on a discount. If that happens and that you keep being able to buy bonds that are paying higher and higher and higher rates, well, by the end of the year, that 2% bond is going to be dirt cheap. You can get it for $12 as opposed to $100. And that's really what happened last year with rates rising as quickly as they did, and you always being able to get a bond a month later that's going to be a better deal for you. Any existing bonds price just plummeted. So you saw that happen here. Now, one of the benefits, it's like ripping a band aid off because what you've seen over the last 10 years is bond returns have been pretty bleh. You haven't had a lot of enticement to own bonds over the last 10 years because rates have been almost zero for the last 10 years. However, with rates being a little bit higher now, not only do you get some bond price appreciation, but you're also getting paid to hold bonds for the first time since pre 2008, which is pretty exciting. So, we're probably actually looking at having some pretty decent bond returns for the next few years, which is really good. Now, I want to wrap up today with some investing principles. We've talked about a lot on economy, we've talked about a lot on the market. I want to kind of say, all right, well, with all of this information, which again, it's information, use it how you want to use it, but I'm not necessarily trying to tell you, hey, do this in your portfolio, do this. I want to just leave you with some general investing principles to think about and to keep in mind as we've just talked about a lot of information. First off is risk and time. So when we talk about risk and we talk about time, I mentioned this earlier, but stocks are the riskiest thing for someone that has a short amount of time before they need those funds or need money. It is the least risky the longer that time goes. So cash and bonds, not very risky short term, very risky long term because they're not going to keep pace with inflation generally. Stocks will be the one thing that really allows growth at that point when we talk about market investing. And again, its risk drops over time. To that point, if you were saving in cash and you were getting no growth. It is very steady, it is very secure, but you don't end up with that much. If you are investing, it's going to grow a lot for you, but it is going to be very, very bumpy. You are going to have volatility. There's going to be times where you have a recession, markets crash, but you see that growth over time. So even as you see this first little dip, you're still over what you would have had saved. The second one, you're still well over this, well over that, but it is not a smooth ride. So when you look at it, you might see a business that's slowly growing. So, like, let's look at Apple here. Apple might just be growing and growing and growing and growing, but its stock price is going to be all over the place. You can look at the same thing as with the economy. You can replace the business with the economy and the stock with the stock market. Is you'll see the economy grow over time, but you'll see the market bounce all over the place. You might have something happen here or something happen here and move, but you see that growth over time. Now, with that, you can benefit from this, but you have to stay invested. So this is an example of someone that if they were to take $100,000, invest in the S&P 500 from 1999 to 2018. If they did that, they'd have about $300,000 at the end of that time period. If they missed the 5 best days, that drops by about $100,000, which seems like, oh, well, that's ridiculous. But when you think about the 5 best days and the 5 worst days in the market typically are extremely close together. So what you can see here in triangles is the best days, and diamonds, or I guess diamonds or sideways squares, are the worst days. They are clustered not only close together, but they are clustered close together typically when you have dramatic markets. So 2008, 2020, uh, late 90s recession, or not late 90s, but like late 90s volatility, not recession. And you have the early 2000s recession right here. So, I mean, you're getting some of the best days right next to some of the worst days. And the likelihood is if you had tried to cash out, you're not going to be able to catch the best days. You're probably not going to be able to, you're going to miss some of the worst days, but I mean, you're going to miss a lot of that upswing. So I think 2020 is a perfect example because you saw a lot of weeks in March of 2020 where you would have a 10% up day immediately followed by a 10% down day. I think that happened 2 or 3 times during that time period. So lastly is keep buying. I always like this chart because I hear these excuses so commonly is, oh, I don't want to buy right now. The market seems really, really toppy. I think I'm going to wait. I'm going to wait to buy until the market gets a little bit cheaper. I'm like, okay, market gets a little bit cheaper. Well, I don't want to buy right now. Things just seem really uneasy. I'd rather wait until things get a little bit more optimistic, Um, I just don't feel comfortable buying right now. Well, what just happened was you talked yourself out of buying here only to be able to talk yourself out of buying right here. And the likelihood is that can just go on anywhere I point. You can talk yourself of, oh, well, the market just had a really big upswing, and I'd rather wait for a little bit of a pullback. You get that pullback, and you're like, oh, well, the market's trending down. I want to wait. So I mean, you're always going to have an excuse not to buy, and there's always a good time to buy because, again, what you're betting on is those businesses continuing to operate and continue to grow for you and innovation to continue. And you want to make sure you can take advantage of that. Probably the easiest way is just making systematic 401k purchases. You don't have to think about it. It goes in automatically. It gets invested, and you don't have to worry about when or where you're buying, just investing through that automated process. And with that automated process, it can be really helpful because what you'd be doing is dollar cost averaging. Dollar cost averaging is where you're kind of buying in on a very consistent, systematic basis. So this is 2 examples, and it's a perfect example in like a down market. So think of this almost exactly like a 2022 going into a 2023, where dollar cost averaging can help you. It can work against you in like a reverse scenario, but generally over time, with the market being kind of volatile like this, it turns out to help in your favor. But in a period like this, someone that does a lump sum contribution into an account of 12,000, or someone that puts 12,000 into account but $1,000 of it every month. Well, remember, you're buying shares. So you're not buying a black box of something that's moving up and down. You are buying shares of a fund or shares of a company, and those shares are being valued up or down depending on kind of how well things are going. So at this one, this first person buys 480 shares at $25 a share. The market goes up and down. End of the year, those shares are worth $27. They have an average price of $25 a share, and they have 480 shares. They're sitting, I believe, rough math is like 12,600, give or take. Now, this person buys $1,000 a month, so they buy 40 shares at 25, 40 shares at 25, 50 shares at 20, 62 and a half shares at 16, And then in turn, when it's up to 27, they only get 37 shares here, but they were able to buy a ton of shares here. So actually, all the shares they have right here already have gains by the time you get to September because it's a $2 more expensive than it was. And these 2 months right here, you have growth on that. So, what ends up happening is not only does this person have more shares and an average lower cost, but at the end of this year, with $27 a share, they're sitting closer to $16,000 as opposed to $12,600 at that point. So, just by taking advantage of being able to purchase when the market's at a discount, essentially, you were able to really catapult your growth over the same time period. So if we take that and we take that all the way back to this chart right here, if you are in a position where you are in a decade where the market is relatively flat and you are consistently buying in, so you have a job, you're contributing to your 401k and you're seeing years like this, you have years before retirement. And even if you're in your retirement, you can position a portfolio to be a lot more secure than this. But say you're in your 30s, 40s, or 50s and you're saving here, buying into decades like this during your working career are amazing opportunities where you can really rack up a lot of shares that once you get to a period like this, everything you purchased here is just going to catapult into growth. Whereas a period like this, like the 2000 teens, everyone always loves because you put money in and you see immediate gratification of it going up. But every single year, you're buying less and less shares because things are getting more and more expensive. So, same principle that we're talking about here, but on a much longer time period. But that's everything I had for today, guys. I appreciate you listening to this, and please check out the other videos we have here. If you do want to sit down and do individual retirement planning, reach out to me here. This is for all Forsyth County employees, My Retirement Plan and Invest Plan Advice, or that is my contact number. Would love to sit down, go over what your personal financial plan looks like. And again, all of it is covered by the county and all of it is available to Forsyth County employees. But thanks and have a great day.